We're going to go into objective 3, and we're going to start talking about computing our different depreciation methods, computing depreciation using our different depreciation methods. So we're going to talk about our straight line, our production method, and our double declining balance. But let's first look at a basic definition for depreciation. We talked a little bit about depreciation, I think it was back in chapter 3. And really all depreciation is the periodic allocation of the value of a long-term asset over that asset's useful life. And we can say that assets have limitations in terms of their useful life. Just like you guys, I equate it back to a car because you guys can relate to that very easily. Okay, you buy a car, you know that car is going to have a useful life of a certain period of time. Okay, you know at a certain point in time you're going to have to replace that car. Okay, well, pretty much every long-term asset that you have is going to have a point in time when it has to be replaced or upgraded or fixed, etc. Okay, so you have depreciation because of a couple of different reasons. You have the physical deterioration of that item. It's wearing down. It's getting used up over time. And then you have what's called obsolescence. And obsolescence is the process of something like going out of date. The easiest thing that I can equate that to is like your computer, okay, or your cell phone, okay? Everybody has a cell phone, right? No. After, what, a year, maybe 2 years at most, everybody's looking to get a new cell phone, right? Because it's obsolete. Is it still useful? Yes, it's still useful. But from a technical standpoint, it's maybe obsolete because there's newer technology out there that makes the newer ones better, faster, stronger, more versatile. Yes, they're like Superman, okay? So obsolescence is the process of something going out of date. So depreciation takes that asset that we have on the books and converts it to an expense, matching the expensing of that item as it wears out with the revenue that it's helping to generate. Okay, so remember, we always have to match our revenues with our expenses. Well, if you think about it, as that item goes down in value over time, it's an expense to your business because at some future point in time, you have to go about replacing that item. So you have to expense that item as it's being used up, and that's what the depreciation does. And depreciation is not necessarily indicative of market value. Why do I make sure I emphasize that to you? Okay, because if you think about it technically, okay, so this land and building that we're sitting on here for our school district, okay, our school might have paid, let's say, I don't know, when they built the school, maybe they paid $20 million for the school when they built it, okay? As the time has gone by, and buildings usually depreciate over 30 years, okay, this asset, the building, has gone down in value, okay? We've depreciated it over time. However, if we were to look at the market value for this building, it's probably somewhere significantly north of that $20 million that was paid for it to be built years and years ago in the 70s, whenever it was built, okay? Because today, valuable land, good location, the building itself is in relatively good condition. Does it need upgrading? Probably, but it's going to probably be valued more from a market value standpoint than it would be from what we call a book value standpoint, which would be the cost of the asset minus any of the depreciation, okay? And that happens, and we'll learn about that at the end of this chapter, okay? So the depreciated value of the asset is not necessarily indicative of the market value. Yes?
Why is that? Why is it that it can go up in value yet it is still losing book value?
Okay. Every long-term asset has a cost basis. what you paid for that asset in cost, okay? But what you can replace it for is a different matter, okay? So 30 years ago when this building was built, however long ago it was, okay, the prices of things were significantly less than they are today, okay? So if we were to go out and try to replace this particular building, the size of it, we could never replace it in terms of the physical location, okay? So that's a factor in and of itself, and part of the reason that land does not depreciate, because this land is only and always only this land, okay? So land is a unique item. So if we were to try to go out and just build this someplace else, it's going to cost us significantly more today than it did 30 years ago. And so the market is just different than it was. So the market valuation is a completely different item than the actual cost less the depreciated value. Okay? Does that make sense?
Yeah.
Okay. All right. So, and we'll look at this a little bit more at the end of the chapter when we talk about selling a long-term asset. Okay. So, what are some factors that impact our decisions relating to depreciation? In terms of choosing, you remember at the beginning, I said there are 3 different valuation methods that we're going to use. There are factors that impact what our depreciation is going to be. First, the cost. And the cost is just the net purchase price plus any expenditures to get that item ready for use. We talked about all of those last class, where we talked about maybe insurance and shipping and installation charges. All that goes into the actual cost basis of your long-term asset. Then we have what we call the residual or salvage value of the asset. This is a portion of the asset's acquisition cost that will be out there on the books long term. Okay? And some assets never depreciate below a certain what we call salvage value. So if you buy certain assets, just the actual maybe metal itself or items itself will always have some value. So we say that the asset will never go below that salvage or residual value. Okay, so let's say you have a car. You buy a car, maybe you bought a $30,000 car. At some point in time, when we consider its useful life to be, or depreciable life to be over with, which is typically for a car 5 years, that car, is that going to have a value? Yeah, it's going to have a value. So that's what we're talking about here. We're talking about that salvage or that residual value. It's going to have some value, below which we will never depreciate that asset, okay? And then our depreciable cost is the asset's cost less the residual value. So our cost, this item right up here, minus whatever the residual value, is the most that we can depreciate on that asset. So if we have our car, and it's a $30,000 car, and we say that in 5 years, at the end of its useful life, it will have a value of $5,000. Then its depreciable cost is $25,000. So we can never depreciate it below $25,000 or more than $25,000. So our cost minus our residual or future value. And then our estimated useful life is the time that we think the asset will be in service. Okay. So depreciation is always accounted for at the end of the fiscal period by doing an adjusting entry. And every year I hear my husband talk about this. You know, his staff is doing all the adjusting entries, okay? So every single adjusting entry is the exact same entry. You're going to debit depreciation expense and credit accumulated depreciation. What is accumulated depreciation? We talked about this in Chapter 3. What type of an account? Contra asset account. So it's going to be associated with each account that is a long-term asset is going to have an accumulated depreciation that is associated with that long-term asset account. Okay? And then in order to figure out what this depreciation adjustment will be, we use one of these 3 different methods for depreciating our assets. Just like we did with our inventory, where we had different inventory valuation methods, same thing here with long-term assets. We have different methods that we can use to depreciate our long-term assets. We have to, again, be consistent. We have to, follow the same rules. We have to have some logic around why we would depreciate certain assets in a certain fashion, etc. So let's talk about them. First method. This is the one we talked about back in chapter 3. It's called the Straightline Method. It's the simplest, okay? We use the asset's depreciable cost, and it's spread evenly over the estimated useful life of that asset. It assumes that depreciation only depends on the passage of time. It does not factor in any sort of things relating to usage, okay? It's only based on the passage of time. And it's computed by dividing the depreciable cost evenly by the life of the asset. Is that the actual life of the asset? No, it's not. It's the estimated useful life. So like I said with our car, we're going to depreciate a car typically over 5 years. Can you use that car beyond 5 years? Absolutely. You'd be foolish not to. Okay? So it's not the actual life of the asset. It's just the estimated useful life for financial purposes. In the straight line method, our depreciation is going to be the same each year, so keep that in mind. And the accumulated depreciation increases uniformly, and the carrying value will therefore decrease uniformly. And you got to pay attention to partial years. So if I bought an asset in, let's say I have a fiscal year of January 1st to December 31st. If I bought the asset in June, am I going to depreciate that asset for 12 months, or am I going to depreciate it for 6 months? 6, right. I can only depreciate it for the period of time that I had it in service. So I bought it in June, I can only depreciate it for 6 months. Okay? So you got to pay attention to those partial years. Okay? All right. So I think we'll stop and do a problem on the straight line method.